This is the third and final video of Module 1. I'll be discussing forms of business ownership and the pros and cons of each one, as well as the things that you might want to know about each one of them so that it would help you with your assignment this week. So the forms of business ownership are important. They carry different degrees of liability, as well as different burdens of taxes, as well as different structures, as we'll get into that, and who controls what happens in a typical business organization. So going through them in order that your book has, from all of this information is in chapter 2. The sole proprietorship is the simplest and probably the most common form of business ownership. It's literally where a person starts a business with their name and they go out and they start conducting business. Construction industry, you could be a bricklayer, electrician, plumber. You could even be a construction company or excavation company, moving heavy equipment around, right up through professionals even, although not likely, but professionals that are, design professionals, that are engineers, architects, surveyors, those type of people can still even be a sole proprietor. The pros for being a sole proprietor is that it's easy to do. There's little to no paperwork to do it. You might have to have a business license depending on what you're doing and where your location is, but there's really very little paperwork to do it. You just start holding yourself out and conducting business. The tax consequences of this are, it's a completely pass-through entity by the IRS. It's as if you don't have a business at all, although you can deduct, all your deductions are there for business expenses, but it's just as if the IRS doesn't even consider it a business other than, for your profits and losses. The downfall to this is that the sole proprietor is personally liable for the consequences of their business. So if you're in the construction industry and you're a sole proprietor that owns a plumbing company, and you're in there and you do something and you do a shoddy job, and all of a sudden everything is built, they turn the water on, and 3 days later all the pipes break and there's water flooded everywhere, and you have hundreds of thousands of dollars in damage. And if you don't have the right insurance, they can come after you personally, and you'll lose your home, your car, and everything else, because sole proprietors have no protection for liability. The next area of discussion was the general partnership. A general partnership is where more than one person joins in a partnership, and each person so you can hold yourself out as a company. You can have all the same benefits as a sole proprietor with regards to pretty easy to do. There's usually a partnership agreement. Most states have adopted the Uniform Partnership Act, which governs how partnerships conduct business. Your liability is still personal. You can still be reached personally with a general partnership. Your liability is generally equal to what you put in as far as percentages, not amounts, but percentages. And yet you can still be reached personally. The partnership, the general partnership, was something that was more popular probably 20 or 30 years ago than it is today. I'd say probably closer to 30. But it is still a viable form of business, and one that people still use from time to time, depending upon the level of liability that they're going to incur. A limited liability partnership. The limited liability partnership acts just like a general partnership, except there's some limited liability on certain partners. Again, most states have enacted what is known as a Uniform Limited Liability Partnership Act. And what happens here is that you have partnership with more than one person. One of the people will be a general partner, and or more. There could be more than one general partner, but at least one will be the general partner. And at least one is going to have limited liability. It'll be a limited liability partner. That limited liability pertains to the amount of the investment. So if a person invests $50,000, they're only liable for the loss of that $50,000. And that is the end of their liability. You can't come after them for more than that. You're not going to get to them for their house and their car and their other vacation home or anything. You're not getting to them for more than what they put in the company. The General Partnership and the Limited Liability Partnership Act, for as far as the IRS is concerned, is passed through entities, and you'll get a statement saying what your profits and losses are, and you'll reflect that on your income taxes, and everything just sort of flows through. Limited liability partnerships are a little more prevalent, a little more recognized and seen today because of that limited liability on some people, some of the investors. But there's still other ways to limit the liability that we're going to get to that are even better than these three entities. The next one is the corporation. Corporations are legally formed separate entities. And I mean that in that it's basically you've created a person, a whole separate entity that now is going to live forever until the corporation is dissolved. Corporations are regulated by statutes, and each state has its own corporate regulations that you can find in various statutes. And the key to a corporation is generally as follows. It has stockholders. Stockholders own the corporation, not partnership, not partners or limited liability partners. Stockholders own a corporation. The stockholders elect a board of directors. The board of directors elects officers or hires officers, and the officers run the company. This is the form of corporations, period. The benefit for this is that there's complete liability protection in almost all cases from the owners. The owners can only be liable to the extent and value of the company. So if a company is worth $1 million and the stockholders own the $1 million worth of stock, and they're all sitting there and everybody's happy, and you get sued for $20 million, the people in the lawsuit are only going to get what the company's worth. You're not going to be able to reach the stockholders. Also, stockholders or corporations can be closely held, which is private stock. I had a corporation that was closely held. I was the only person that owned stock. Or you can have a closely held can have more than one stock owner, but the other option is publicly held or publicly traded. And that's what you see on the stock exchanges. So the advantage to corporations is a complete protection of the owners of the company from any liability beyond what the worth of the company is. There's two benefits here for tax purposes. One is a C Corp. These are your larger companies, and they will pay double taxation. In other words, you will pay taxes as a corporate business, and then you disperse your profits to the owners, and the owners will pay taxes on the profits. That's double taxation. In a closely held corporation, this could be quite expensive. You know, if you only have one or two or three owners of a double taxed corporation, they're going to pay a lot of taxes. The first one will be on the company, and the second one will be on them individually for the profits. And it's a lot of money that comes out on this double taxation rates. And it requires a lot of accounting to try to minimize the effect of the taxes. The other more common corporation designation is called an S Corp. And the S Corp is an IRS designation that allows for all the protections and formation of a company, but that the profits are not taxed twice. They are handed down, profits and losses are handed to the ownership based on percentage of ownership. And they will file individual returns using a K1 instead of your W4 or W2, I mean, they'll use a K1, and that's coming from the corporation, and it has their profits and losses and their share of everything on that K1, and that's what they'll use for their taxes. But it's only single taxation, and it's complete protection from liability beyond what the company's worth. The last entity to be talked about is a joint venture. The joint venture is still used today. Joint venture typically occurs when two entities want to get together for the purpose of building one project. The ones that I see typically are something called a public-private venture. Some people refer to them as public-private partnership. But a public-private venture is one where the public is the government. The government enters into a joint venture with a private party, usually someone like a contractor or a company that's going to do the design, bid, build for something. The government will offer up the land, will offer up certain resources, will offer up most of the money. The private party will run everything and organize it and put up some of the money as far as like ownership goes, and the two of them work together and put together a project. This is something that generally allows for a faster project. I've seen it with schools. I've seen it where the government owns the land, and they wanted to build, I don't know, 8 or 10 new schools or renovate schools that were in Prince George's County. And I put in a bid for the surveying services on those properties, and but it was a private-public partnership or public-private partnership between the government and an entity that was going to assist them in building everything. So these are the forms of ownership. You have an assignment this week that directly relates to the forms of business ownership. So hopefully this was helpful, and I look forward to seeing the work you put in on this assignment.